Hey guys, this is Carl Everest of Trading Crypto Course. Today we're going to talk about divergences. You're probably familiar with using price action when you're trend trading and looking for new entries. For example, in this downtrend, that consists of multiple lower highs and lower lows. What we want to see when we want to enter in a new trend is that price makes a higher high followed by a higher low, and next I want to see price break above this higher high to confirm the uptrend. So what you see is a high, another lower high, and next price tries to make a higher high but gets exhausted once it reaches the previous high, makes another lower high, lower high, lower high, lower high. And next, if you compare it to this level, it makes a slightly higher high and another higher high. So here we can see an early uptrend forming with higher highs and higher lows. But sometimes, or actually quite often, we're in a downtrend and price is making lower lows, like this, low, lower low, lower lows, lower low, lower low. The RSI indicator that I installed down here is actually making higher lows. Like here, we have a lower low on price action and we get a slightly higher low on the RSI indicator. And this is what we call a divergence. And this is what we are talking about today. When price is making lower lows while the RSI or other oscillator at the same time is making a higher low, this means a shift in momentum. It means the downtrend is losing steam. It's a divergence between price and momentum. And as you can see, these divergences of this divergence is a leading signal because price is making a lower low while the momentum is already shifting upwards. And next we see momentum break above RSI 50 and even above RSI 60, confirming an early uptrend, reaching until above RSI 70. So this is why divergences are regarded as leading signals and give us traders an early warning. There are actually two main types of divergences. There are bullish divergences and bearish divergences. Please feel free to pause the video and take an extra good look at these divergence examples. Next, let's zoom in into this early uptrend attempt so I can show you how I use bearish divergences to get out of an uptrend. So as you know, the uptrend we see over here consists of higher highs and higher lows. And as you can see, when this higher high forms on the price chart, the high on the indicator is actually a lower high. So that's the divergence. This makes another higher high while the RSI indicator is already making a lower high. So that's a clear signal that the upward momentum is diminishing, and this could mean the end of the uptrend and a reversal, but that's not clear. That's not what divergences tell us. It could also mean that the price is going to consolidate, move sideways, or continue up later on. It's interesting to see that right after the RSI indicator made a divergence, made a lower high, just after that price dropped and made the first lower low, you see? And the last higher low is now respected as resistance. So this means price action is confirming what we already saw before on the RSI indicator. A clear example of divergences being a leading signal. So now you see that divergences can help you entering and can help you exiting a trade. But that's not all, guys. There's also something called a hidden divergence. Let's show you some examples. A lot of traders find these hidden divergences more difficult to understand, to comprehend. But it's not really difficult at all. Let me explain. You see prices making a higher low while the indicator is making a lower low. This is not bearish, this is a bullish signal. It means the indicator went all the way down and can only go up. So it's a bullish signal. And now the hidden bearish divergence. This means price is in a downtrend, making a lower high, and at the same time you see on the indicator a higher high. This means there's not much room to the upside on the indicator, so chances of it going down have increased. So it's a bearish signal. Of course you can pause the video and watch these examples carefully, because they're very important. So the normal divergences can be used to spot the end of a trend or a trend reversal, but these hidden divergences are not only a signal of a potential trend reversal, but can also be used as a possible sign for a trend continuation. Let's take a look. I zoomed a bit back on the same chart, and right here you see a downtrend we were in, and price making consecutive lower highs and lower lows. And what we see over here is that price is making another lower high, but at the same time the indicator is making a slightly higher high. Okay, and that's a bearish divergence, that's a hidden bearish divergence. And next price continues its downtrend, so a continuation pattern. Now I zoom a little bit further towards this uptrend that consists of consecutive higher highs and higher lows. And right at this moment, where price makes its last higher low, the indicator makes a lower low. And this is a bullish divergence, this is a hidden bullish divergence. A continuation pattern, as you see. After that, price makes another higher high. And that's just before the trend ends, because the indicator shows us that price got exhausted and wasn't able to make a higher high on the indicator as well. So there was a bearish divergence, a normal bearish divergence. But before that, that's why I wanted to show you this. Price made a last final higher low, while the indicator made a lower low. So it gave some room to the upside for price to make another leg up. Does that make sense? Okay. When I'm drawing these divergences, I usually draw them at the body of the candles, of the bars, so not at the wicks. But when I'm drawing trend lines, I do use the wicks. As a matter of fact, I want to let them touch as much wicks as possible. But when drawing divergences, I use the bodies. It's also good to remember that drawing divergences, using divergences, works best with large swings, so in strong trends. In sideways markets, this is not reliable at all. And next to that, always have patience. Often traders enter a trade too soon, right after they saw the divergence. It's much better to wait for extra confirmation. So it's much better to look at chart patterns, supports and resistance, trend lines, etc. Okay guys, that's it. For more free trading lessons, please visit my course website, tradingcryptocourse.com. I have a lot of free lectures on a wide variety of crypto trading topics. I'm Carl Everest and this is Trading Crypto Course. Please like and subscribe if you haven't already, or leave me a comment. I have a lot more crypto trading videos to come, so stay tuned and take care everybody.